Chapter 10 is all about money and banking, but before we really start talking about money and banking, we're going to go into what money is used for and really talk about how people make decisions about whether or not to consume now or in the future. And in order to do that, we need to think about whether people are borrowers or lenders. So money is a medium of exchange. That just means it's used to buy and sell stuff, right? So that could be the cash that you have in your pocket, the deposits you have at your bank, the checks that you use to move those deposits to somebody else. And what it does is allow purchasing power, the ability to buy things, to be moved from one person to another. And the key thing about money is that it works because everyone trusts that it will work. When people lose that trust and lose trust in the value of money, the economy tends to fall apart. And that happens when economies experience something like hyperinflation, where the value of the currency erodes very quickly and the economy tends to freeze up. So when we think about money, we want to think about the difference between wealth and income. So wealth is a stock variable, right? We've talked a little bit about stock variables and flow variables before. A stock variable is something that is measured at one time, and wealth is the measure of everything that you own. So that could be buildings, it could be land, it could be machinery, it could be capital goods. Um, you have to subtract any debts that you owe to other people and add in any debts that are owed to you. So if we think about wealth and income in terms of a bathtub, wealth is the amount of water that is in it. Income is a flow variable, right? So it's the amount of money that you receive over some period of time, whether that's an hour, a week, a year. And it could be from, wage and salary, from your market earnings. It could be from investments, interest that you get, dividends that you get, or it could be from the government, transfers, things like unemployment benefits or food stamps, anything that is a transfer from the government. The income flows in, right? And so if we think of income as flowing into the bathtub, then we can think of two other things that flow out of the bathtub. One is consumption, right? You have to spend your money on the things that you want to buy, food, housing, clothing, entertainment, etc. And the other is depreciation. So for depreciation is more related to physical capital. So the thing, depreciation is basically how fast it wears out and how much needs to be replaced every period. When we think about depreciation, you think about a machine that gets worn out because it's being used. You think about a building that needs to be repaired. Those are the types of things that depreciate. Your net income is how much you could consume without running down your wealth, right? So your net income is your gross income minus depreciation. We also think about disposable income. Disposable income we think of as market income minus taxes that you pay to the government plus any transfers you get from the government. Earnings, wages, salaries, bonuses, etc. Savings is any income that's not consumed. So if you earn $1,000 a week and you spend $800 and your savings would be $200. And investment is expenditure on newly produced capital goods. So this is a little bit different. It's one of those terms that economists use a little bit differently than people in everyday life. When we talk about investment in economics, we're talking about buying a new machine, a new truck, a new computer, a new factory, a new store, something that's going to be used to produce more goods and services as opposed to buying financial assets. So what we're going to start off talking about is the idea that if you consume more today, you have less to consume in the future, right? And if, on the other hand, if you want to consume more in the future, then you have to consume less today. And sometimes you might have more assets in the future than you have now, and so you want to borrow, you want to bring some of those assets from the future to today. And sometimes you might have more assets now than you'll have in the future, and so you want to lend some of those assets now so that you can get paid back in the future and bring those assets into the future. So if we think about borrowing, we can think about it as, basically a trade-off between consumption now, which we have on the horizontal axis, and consumption later. And so in this case, in this chapter, Julia is our borrower, and she's going to have $100 sometime in the future, but she doesn't have any income today. And so If she doesn't consume anything today, then she'll have zero, but she'll have $100 in the future. But she could borrow. And if she borrows, there's a certain sort of maximum amount she can borrow, which is going to depend on the interest rate, which we think of as R. And that interest rate is going to determine the feasible frontier, the feasible set of what she can consume. So we see if she has an interest rate of 10%, the most she could consume now is $91. And then she would have to pay back 91 plus the interest, 10%, which would be $9. And so she would have to pay back all of her $100 in the future. On the other hand, if she consumes $70 today, then she would have to pay that back, 70 plus 10%, 77, and 100 minus 77 is $23. That's what she would have to consume tomorrow. Similarly, she could borrow $30 and consume that today, pay back 33 in the future, and then have 67 left. On the other hand, if the interest rate goes up substantially, for instance, if it goes up to 78%, then the maximum amount she can consume is $56 today. And so her whole feasible frontier shifts in. And that means that the higher interest rate forces borrowers to consume less now than they would otherwise, and a lower interest rate allows them to consume more. So if borrowing allows us to bring consumption forward, meaning, hey, we've got some income in the future, it's not doing us any good in the future, we'd like to bring it forward. And how much people will choose to do that depends on a few things. One thing is that people tend to like to smooth out their consumption, um, mostly. So you don't want to consume nothing today, right? Consuming nothing at any point is going to be a problem because you're not going to eat anything and you're going to die. So that's not really an option. Um, but people like to sort of have more or less equal amounts of consumption, possibly with some slight increase over time. Um, so that's going to be one reason that people will either borrow or save. And the other is impatience. And so there's a lot of evidence that people have a bias towards the present. And that means that they're more likely to consume today than to wait and consume the same amount in the future. So if we think about the choice between consuming now and consuming later, we can think about it very similar to any choice between consuming one good versus another good, and we can draw indifference curves. Remember, an indifference curve shows all the combinations that give you the same utility. And so any combination, it's C and E on this light blue indifference curve, Julia gets the same utility. But she gets higher utility on this indifference curve that goes through point F. And so people will choose the point on their indifference curve that is highest and gives them the most utility depending on their budget constraint. So consumption smoothing, may appear that people are impatient, right? Because they want to borrow now, but there's a difference between that and pure impatience. Pure impatience is really about either myopia, in which case people are just saying, well, I can't even think sort of into the future. Myopia sort of meaning blindness, right? You can't think into the future that far, and you really just want to consume now. Um, that's one reason. The other reason, which could be related to it, especially from an evolutionary point of view, is prudence, right? If you don't know you're going to be not, if you don't know you're going to be around in the future, it might make more sense to consume now. I think it was Mickey Mantle who said that, he didn't expect to live past 50. He never would have drunk as much as he did in his 20s if he knew he was going to live so long. So, the question then is, if your endowments are the same in both periods, do you consume more now or do you consume more later? If you just smooth your consumption perfectly, you'll consume the same amount in both periods. If you do consume more now than in the future, then you're at least a little bit impatient. If you consume a lot more now than you do in the future, then you're much more impatient. So then the optimal decision making is going to depend on this discount rate, right? That is related to people's preferences about consumption smoothing and pure impatience. And they will consume at the point where the discount rate is equal to the rate of interest. So in this case, if Julia is facing a 10% interest rate, then she consumes at point E. and we know that her discount rate at point E must be 10% as well because the discount rate has to equal the interest rate. If she's facing a much higher interest rate than she consumes at point G, in which case we know her discount rate at point G must be equal to 78%, which is the interest rate faced on that feasible set.